since 2008. We're breaking through the 200-week moving average, and once we break through that, I do believe we will be on a sustained bull market. You could call this a bull market, but what it really was the shutting down of the global economy for the best reasons ever in the world that nobody may ever dispute. But if we iron that out as just a little blip of insanity, we're about to embark on a gold bull market relative to commodities, and silver will of course follow. And in that final year of the gold bull market, as we saw in the late 1970s to 1980, silver should break out. It should be quick, it should be brutal, and it should be glorious.
In recent times, the gold market has seen significant fluctuations, with prices bouncing back in Monday's trading session after a previous week's decline. Investor responses to the robustness of the US dollar and adjustments in anticipation of potential Federal Reserve rate cuts contributed to this downturn. These adjustments were made in response to mounting evidence of persistent inflationary pressure, prompting traders to seize any opportunity for profit amid this backdrop. Renowned investor Rafi Farber sheds light on a noteworthy development: the nearing of a crucial juncture in the gold to commodities ratio, as it edges closer to its 200-week moving average, a milestone not seen since 2021. This impending breakthrough carries significant implication, hinting at the potential commencement of a major bull run for gold compared to other commodities. This ratio serves as a key indicator of the profit margins enjoyed by gold and silver miners, with a higher ratio signaling enhanced profitability for these miners, thus underscoring the importance of this imminent milestone. The prospect of surpassing the 200-week moving average is rare in gold markets, with such occurrences being sparse since 2018. Farber interprets this event as a robust signal, heralding an imminent and sustained bull market for gold relative to commodities, brushing off recent disruptions in the global economic landscape as transient rather than indicative of long-term trend. While silver encounters resistance in its ratio to other commodities, Farber anticipates a breakout, drawing parallels to historical pattern. He suggests that silver's anticipated breakout may coincide with the concluding stages of the existing gold bull market, mirroring the rapid and impactful movements witnessed from the 1970s to the 1980s, hinting at the potential for significant and decisive shifts in silver's value. Clips from Rafi Farber's interview with Arcadia Economics will be presented to delve deeper into these insights. But before we proceed, please remember to show your appreciation for this video by giving it a thumbs up.
Something is happening here. This is gold relative to other commodities. It's important not to confuse a commodity bull market with a gold bull market. There's a reason that we are gold and silver stackers as opposed to, let's say, oil or natural gas stackers, though there could be natural gas stackers. I don't think that's particularly healthy. What we see here is the gold to commodities ratio, and basically it's been in a trading range since 2011, since the 2011 top here. And we see here that the bull market really began in 2008. This was the beginning of the destabilization of the financial system. It was stable over here, the gold to commodities ratio, pretty much until 2006. And then it started to move up, and then in 2008 it really moved up. But since 2011 it's been in a trading range, and also since 2021 we've been below the 200-week moving average, but that is now finally changing, which is suggesting that we are on a major bull run of gold relative to other commodities. And this ratio is really it's a proxy for the profit margins of gold and silver miners. So the higher this ratio goes, the more profitable miners are. If we zoom in here, we can see that we are right on the cusp of breaking the 200-week moving average for the first time since 2021. This is a very rare event in gold markets. The 200-week moving average is at 8.11 here, the red line we see, and we are at 8.10. We're just about to break it. Let's see how rare this is. Well, this has happened about 3 times since 2008, when the gold to commodities bull market really started. So it happened once in 2014, at the end of 2014, and that looked like a gold bear market, but it was really a bull market relative to other commodities. It was a commodity bear market, but gold was falling much less. And here it happened again in 2019, though we had barely gone below the 200 moving average here. So if you want to count this, fine. If you don't want to count it, you don't have to. You know, technicals like this isn't more of an art than a science. And here we have, for the third time since 2008, we're breaking through the 200-week moving average. And once we break through that, I do believe we will be on a sustained bull market. You could call this a bull market, but what it really was the shutting down of the global economy for the best reasons ever in the world that nobody may ever dispute. But if we iron that out as just a little blip of insanity, we're about to embark on a gold bull market relative to commodities, and silver will of course follow. If we zoom in on silver, See what's happening here. Silver relative to other commodities. We are at resistance here in the silver to commodities ratio of about 0.09.1. We're just below the 200-week moving average, so we're gonna break through it. It's just gonna take a little bit more time, and once we do, we should be in a silver bull market also relative to gold. And in that final year of the gold bull market, as we saw in the late 1970s to 1980, silver should break out. It should be quick, it should be brutal, and it should be glorious.
In essence, a significant shift is underway in the dynamics between gold and other commodities. It's crucial not to confuse a commodity bull market with a gold bull market, as gold and silver tend to play unique roles in investors' portfolio. The gold to commodities ratio, which has been in a trading range since 2011, is now approaching a pivotal moment. Since 2021, we've been below the 200-week moving average, but this trend is changing, suggesting a forthcoming major bull run for gold relative to other commodities. This ratio serves as a proxy for the profitability of gold and silver miners, with a higher ratio indicating greater profitability. Breaking through the 200-week moving average is a rare event, occurring only 3 times since 2008. This impending breakthrough signals a sustained bull market for gold, which may also influence silver's performance. Silver, currently at resistance in its ratio to other commodities, is expected to break through soon, potentially leading to a silver bull market alongside gold. Drawing parallels to historical patterns, particularly from the late 1970s to the 1980s, the anticipation is for a rapid, impactful, and glorious breakout in silver's value, marking the final stages of the existing gold bull market.
I wanted to go into the banking situation here. This is banking reserves. Bank reserves are reserves that banks hold at the Fed. So this is really the liquidity line, how much extra liquidity banks need. Now, the higher the pyramid goes, the more liquidity that there is in the system, the more liquidity that is needed, because banks obviously make loans and therefore they need reserves to cushion against those loans, and they themselves go into debt. So the more reserves there are, the more reserves are needed, which is why I drew these 2 lines in. You see here, this is right before QE3 in 2012, and then QE3 brought us up to a new level of reserves just below 3 trillion. And then once we fell back to the pre-QE level of reserves, we hit a repo crisis, and that was in September 2019. So we see the same thing here. We hit a new level of reserves because of the crisis over here, which we don't want to talk about. And then we hit a high over here just as 2022 came into being. New Year's 2022, we hit a high, and then QT starts again. The Fed starts shrinking its balance sheet. We head down to about $3 trillion, the previous line of where the new QE line stopped initially. And then we hit another banking crisis. This is around March 2023 over here. And so we're heading down again. We're going to zoom in a second. I'll show you how far we are from this new banking crisis line, which I assume is about $3 trillion. It's not going to be exactly then, and it's not going to hit exactly when we hit the line. We see here in the banking crisis of 2023, it took a few months for this line to be approached, for the banking crisis to be triggered. But it is around $3 trillion, and it will happen somewhere around there. If we zoom in, we can see here we are at $3.25 trillion. This number over here is about 3.585 if I remember correctly. So we're down about $330 billion in the last 3 weeks. We could hit the crisis line anytime, and there's no reason that we shouldn't, because we're still in QE, and even though the Fed announced that it is slowing down QE, it is continuing, QT. They are slowing down QT, but they are continuing it, and the slowdown will only happen in June. So we have another 4 weeks to fall another $252 billion to reach the $3 trillion crisis line, and then it should take a few weeks, maybe a few months, for the next crisis to be triggered somewhere in the repo market, somewhere in the banking system. I don't know exactly where it's going to hit, but it is definitely going to.
In analyzing the banking situation, it's essential to focus on bank reserves held at the Federal Reserve, which serve as a liquidity indicator for the banking system's needs. The higher the reserve levels, the more liquidity is available for banks to lend, thereby requiring more reserves to cushion against loans. The narrative follows a pattern. A crisis leads to a surge in reserves, as seen in the aftermath of QE3 and again in 2022. However, the Federal Reserve's initiation of quantitative tightening, QT, brings reserves down, potentially leading to another crisis, akin to what occurred in March 2023. Currently, reserves are around $325 trillion, with an anticipated decline towards the critical threshold of $3 trillion. With QT ongoing, the banking system may face stress, potentially triggering another crisis in the near future, though the exact timing and location remain uncertain. Thank you for your continued support. Share your thoughts in the comments below. Don't forget to like, subscribe, and turn on notifications for more enlightening content on precious metals and financial strategies. Thanks for watching.